对话全球顶级机构，换一种思路看中国。大家好，欢迎来到中国基金报独家打造的高端对话节目《巅峰对话》，我是主持人娟娟。随着中国资本市场对外开放进程的推进，外资已经成为我国资本市场一支不能被忽略的力量。他们通过各种渠道参与中国投资，布局中国市场，设立合资公司、设立独资公司，或者通过我们的沪股通和深股通参与 A 股投资。与此同时呢，我们中国的机构也在积极的出海，参与全球市场布局。那么，外资投资 A 股的思路是什么？和国内的机构有没有不一样？而中资机构出海又能为我们的投资者带来什么样的机会？今天呢，我们请到了2位嘉宾，他们会就这些问题展开讨论。一位呢是来自重阳投资的董事长王庆，另外一位是来自美国陆博迈集团的总裁和股票方面的首席投资官 Joseph Amato。现在呢，王博已经来到了我们的现场。王博你好，和我们中国基金报的粉丝打个招呼吧。
我们中国基金报的粉丝们，大家晚上好。
谢谢王博。那我接下来呢，简单的介绍一下重阳投资。重阳投资是国内最早的一批阳光私募之一，它坚持自下而上的个股和行业研究与自上而下的宏观研究相结合，是一家综合实力非常雄厚的投资机构。那重阳投资的愿景呢，是成为一家受人尊敬的投资机构。今天呢，我们先和王博聊一会儿，然后等一下呢，我们来连线陆博迈的总裁和首席投资官 Joseph Amato。王博你好。
你好。
2003年我们的 Q 费制度落地以来呢，外资在中国能做的事情越来越多了。从去年的数据来看呢，去年年底外资境外的机构和个人持有 A 股的市值已经达到了接近4万亿。公募基金的数值是超过6万亿，所以说他们在 A 股市场的作用越来越大了。那回顾过去这10几年，觉得外资对 A 股市场最大的影响是什么？
其实过去这么多年，随着外资参与中国 A 股市场越来越程度深呢，的影响也比较明显。尤其是在这个我们 A 股加入MSCI 指数以及这个我们的陆股通、港股通开通之后，这个影响更加明显。应该说，就是它主要体现这几方面吧。因为外资呢，相对来讲，我们一般说它的投资理念、投资方法上更成熟更注重基本面分析偏价值策略。然后呢，尤其对中国转型方面的这个受益的行业板块呢比较看重，比如说消费、医药科技等等。所以呢，这些外资呢在这方面的这个持股呢也都相对的比较集中所以这些影响呢，实际上呢使我们的 A 股市场也这个日益成熟吧比如说我们在2017年我印象中2016年、17年，我们 A 股市场就出现了这个优质蓝筹股的这个一次性的重估。我相信这跟外资的参与的积极影响是分不开的。现在呢，刚才你也提到，现在我们这个外资持有 A 股的比重大概是4万亿嘛那实际上从比重来讲还不算是很大那么现在的持股量占自由流通市值也就10%左右，而总市值呢不到5%。你要以我们的台湾和韩国的经验看呢，外资持股的比重呢高的时候能达到1/4所以你要说前瞻性的看的话，应该说外资对 A 股的影响可能还会进一步的加大。
还会持续是吧？其实您刚才也提到了我第2个想问到的问题就是说去年呢，北向资金净流入了超过5000亿，是创了一个历史的新高。那觉得今年 A 股对于国际投资者的吸引力怎么样？
我相信 A 股对国际投资者吸引力呢，今年仍然会比较强这里既有今年特殊情况，也有 A 股的一般的特征我们先谈谈 A 股的一般特征呢，就是说，首先呢，实际上你要看 A 股的长期的投资回报率的话是不低的那么所以它 在收益率上是有吸引力的，这是一点。那么另外一点也是对国际投资者同样有吸引力的地方，就是 A 股市场的表现跟全球市场的相关性很低，那么这样呢，对于全球一些配置型的资金呢，就变得很有吸引力了。因为你要做配置的话，一定要寻找这个相关性不高的但是收益率又很不错的资产构建一个投资组合嘛。所以从这上来讲 ，A 股呢在全球市场上是有吸引力的所以这是第二点。第三点呢，就是说A 股呢这个市场呢给这种主动管理型的投资管理人寻求创造阿尔法的来源呢还是比其他市场多。这一定上，因为我们的 A 股市场相对不够成熟嘛，那么我们的经济增长速度也比较快，经济结构变迁也比较快，所以呢，给这个基于研究的这种主动管理型的投资管理呢，创造这种阿尔法这个机会的更多所以呢，有更大的主动管理这种投资管理人的这种运作的空间所以这个对外资也是有吸引力的。当然，至于说我们2022年 A 股市场对全球投资者吸引力呢，我相信还多了一层就是我们跟前面提到的我们A 股的表现跟全球其他市场的相关性不高，而在2022年呢，实际上呢，就是我们的经济周期和政策周期决定的资金的流动性周期呢，跟国际市场是不同步的。那么我们2022年呢，很可能呢 A 股市场呢走出的这种行情跟这个国际市场不一样那么尤其是我们倾向于认为呢 A 股市场的表现会超越国际市场的这样一个总体的表现。所以从这个意义上来讲，2022年在此基础上呢，它会对国际投资者呢会有更明显的吸引力吧。
就无论是从收益水平来说，还是说它作为分散组合风险的作用来说，都还是很有吸引力的。2022年，那其实我刚才有一个相关的问题您刚才提到就是国际投资者也有很多的海外投资者，他们提到就是 A 股是一个阿尔法的富矿，而且是现在很少见的一个阿尔法的富矿。但是呢 ，A 股的这种机构化的进程也一直在持续，所以大家就想知道这个阿尔法的富矿还能挖几年？
这个应该说应该还是很有空间的吧，因为的确是A 股市场的这个机构化的程度在提升嘛那么我们的很多股民逐渐变成基民那么但是呢A 股市场的这个投资者结构呢还远未到成熟那么我们的个人投资者占的比重呢这个超过了50%，那从交易量上来讲比重更高甚至70-80%。所以呢，在这样一个市场结构下，投资者结构下呢，我相信专业的机构投资者这个创造阿尔法的空间这个还是很大的可能会持续相当长的时间比如说我们就在不久前刚公布的数据，我们 A 股市场有2亿的投资者这就是一个很这个明显的一个我们说明我们 A 股市场的特点
就我们机构化的进程刚刚开始，大家不用着急。
对
，OK。另外呢，就是您本人有着丰富的这个海外机构工作和这个国内投资机构工作的经验就想跟您请教一下，您认为海外机构他们在研究中国公司和研究中国经济和国内机构呢，有没有什么各自有什么优劣势呢？
是有所不同的那么应该说，国际投资者这个他们做这种资产管理机构化资产管理的历史比较长，所以经验比较丰富，投资理念投资风格上呢更加成熟。那么由于他有国际视野，对这个各国的经济的周期、产业变迁的周期甚至资本市场的这种起伏的规律性呢把握呢因为有更多的样本嘛，那么他可能把握也就 更准确。那么同时呢，有这种对这个不同类型的上市公司的合理估值的方法呢，可能也就更先进一点啊。所以这是他们通常是这些国际投资者的优势。但是呢，我认为这些优势实际上仍然有，但是不是那么明显的，因为我们 A 股市场投资人呢也学得很快很快的就赶上来了。那么比如说价值投资啊，长期投资的这种理念呢，都在深入人心。那么同时呢 ，A 股我们市场的投资人呢也有它的独特的优势。这个优势就是说有对中国经济、中国资本市场、中国上市公司有更深刻的理解有更多的这个研究资源，那么可以深度的挖掘这个阿尔法那么广度深度广度上都有这个外资投资者呢无法比拟的优势所以从这方面上来讲呢，我觉得A 股的投资人和海外的投资人呢应该是各有千秋吧。如果说这个海外投资者相对 A 股投资者有什么仍然有什么明显优势的话，我觉得这个优势呢可能不一定体现在研究能力上，而体现在他们的资金性质上海外投资的这个投资人的资金性质更长因为比较长的话，所以他就能够看得更长远一点那么这个所以就可以看得站得更高，看得更远，那么研究得更深而我们这边呢这个由于刚才提到的这个机会化程度的不高呢，所以我们资金性质相对来讲是比较短的所以这个差距呢不是我们研究能力的差距，就是完全是资金性质决定的。那么这方面的这个差距要想完全的弥合的话恐怕要和我们的 A 股市场整体的机构化的进程是相关的。
也就是说，我们 A 股的国内的投资机构实际上是面临在做一道更难的题。
的确是因为我们既要深度的研究既要看得长又要看得远，但同时呢我们的资金的来源呢又没有那么长所以呢它要把握一个艰难的平衡。所以在 A 股市场呢要做好投资的话做好令投资人满意的投资呢实际上是更困难的那更困难也意味着如果做得好的话你会受到更大的这个奖赏
明白说得非常好。那这几年呢，价值投资在中国是一个热词儿。所以价值投资呢，作为一个我们从国外借鉴来的概念它在中国被发挥。然后现在呢，每个人都对价值投资有自己的定义，1000个人就有1000种价值投资。所以我想跟您请教一下，您认为在国外做价值投资和在中国做价值投资有什么不一样吗？
我觉得价值投资作为一种投资方法来讲，它只是一种方法应该说是普世的没有什么不一样的地方。那么尽管每个人对价值投资有不同的理解，那么我觉得比较经典的理解应该是这样的，就是价值投资呢应该有两个要素第一个要素呢就是这个要通过这种基本面分析来评估这个上市公司的内在价值。那么这种基本面分析呢，要基于这个上市公司作为一个企业，它产生未来现金流的能力来做出评估。这是首先要评估它的内在价值。其次呢，要在这个它的市场价格明显低于内在价值的时候呢，买入这家公司，这样有足够的估值的安全边际。那么随着这个价格呢，更加准确地反映这个内在价值，有一个价格反映价值的这样一个所谓均值回归的规律所以这是价值投资的两个基本的要素。那么从而呢也就产生价值投资者获取投资收益的两个来源。第一呢就是说我们的上市公司内在价值本身的成长。第二呢就是说随着这个价格反映价值这种均值回归呢本身是带来从低估到合理估值合理的这样一个收益来源。那么从这个意义上来讲，实际上无论是海外啦还是 A 股市场呢都是一样的所以你也注意到我们这个在 A 股市场上，无论是 A 股的优秀的价值投资人和海外的优秀价值投资人，在 A 股市场都能取得
非常优秀的业绩。当然，这个践行价值投资在 A 股市场呢，有不一样的地方啊，那么主要是也还是回到就跟我们这个市场的成熟度啊、投资结构之间这个不一样比如说我们在 A 股市场上，由于这种投资者结构的相对不成熟呢，可能这个大家对上市公司内在价值的评估可能是没有差异。但是在中短期内，股价明显偏离内在价值时间可能会更长这是我们 A 股市场的特点。那同时呢，就是说当价格向价值回归这个趋势一旦形成的时候，由于这个我们市场的这种动量效应或羊群效应比较明显，它是回归速度可能也比较快所以这是 A 股市场的特点。所以我们重阳投资呢，作为这个价值投资的方法的坚定的践行者呢，我们总结在 A 股市场上，如果说更有效的价值投资的话，我们总结就是要把逆向投资和价值投资做一个有效的结合。而在实践中呢，这种有效结合呢，就是我们重阳投资这个比较善于做的价值投资接力法。
我们另外一位嘉宾来自美国的陆博迈集团，您之前跟陆博迈集团有接触吗？对他们有什么印象？
我之前有过接触那个我因为曾经在摩根斯坦利工作嘛，我印象中我在2008年发生次贷危机的那个最关键的那一周，也就是雷曼破产那一周呢，我正好在纽约当时呢，我作为这个摩根斯坦利的这个大中华区首席经济学家呢，拜访过他们办公室但是呢，随后呢接触并不多那么这个有些听闻吧，那就是它有很长的这个历史超过80年的历史，管理规模也非常大4000亿的这个美元的规模，在全球布局多资产所以这样一个资产管理公司能够经营这么多年，规模这么大，一定在公司治理经营管理方面有独到之处。有一点我对他们印象最深刻的地方，就是说他们的核心基金经理平均的从业时间超过了25年，而且最重要的是，他们平均在陆博曼一起工作的时间是超过了13年，这个使我印象很深刻。因为这两个数字在我们重阳是分别是我们重阳的核心基金经理的从业时间呢是平均是20年，那么他们在一起这个在重阳工作的平均时间是15年因为我了解重阳，所以我就知道这两个数字实际上是非常不容易的在我们这样一个资管行业里面所以我也是非常期待更多的了解陆博曼，然后呢，我相信有很多方面是值得我们这个学习的。
好，接下来我们进入第二部分。王博将和来自美国陆博迈的 Joseph Amato 就今年的资本市场展开讨论。那在连线之前呢，我来简单的介绍一下陆博迈集团。陆博迈集团呢是美国一家位于纽约的资产管理机构，它最新的资产管理规模呢在4000亿美金，也就是超过2万亿人民币的样子。陆博迈集团是美国历史最悠久的共同基金，也就是相当于我们的公募基金之一。它拥有83年的历史，它的创始人 Neuberger 在美国被称为共同基金之父。那陆博迈集团有几个鲜明的特征，第一呢，它是所有的股权由员工持有，没有外部股东，这样一种股权结构的安排呢，给了它一个长期主义的基因。此外呢，陆博迈集团是美国比较少见的公募基金和另类投资齐头并进的机构。那今天参与我们讨论的呢是 Joseph Amato， 他是陆博迈集团的总裁和股票方面的首席投资官。现在 Joe 已经在线上了，我们来连线 Joe。 So hi Joe, thanks for joining us. And could you please say hi to our audience?
Hello, great to see you and be with everyone today in a sunny day here in New York City.
Wow, that's good. And I have with me Dr. Wong from Chongyang Investment. And Chongyang Investment Management is a leading private securities fund in China. Before joining Chongyang, Dr. Wang worked for Morgan Stanley and the CICC, the latter of which is top investment bank in China, and before that, he worked as an economist for the International Monetary Fund in Washington, D.C. Okay, so I'm thrilled to have you both joining the conversation, and especially in this very challenging and also depressing time. So I hope we can bring some positivity to the capital market, which is not necessarily what Wall Street do. So I want to start with inflation. Neuberger Berman has published extensively on inflation recently. So with inflation in the United States reaching a 40-year high, how should people, especially in the Main Street, buckle up and do their investment?
It's an important question. As you say, inflation is at the highest levels it's been in multiple decades, and our expectation is that inflation will continue to remain high, but ease over the course of 2022 and into 2023 as a number of short-term factors work through the system, whether it's supply chain or other related issues that will help mitigate inflation. But we do expect inflation to remain structurally higher than it's been over the course of the last number of decades. And from an investor standpoint, you've got to invest in assets that are inflation sensitive, if you will, whether it is floating rate debt, either sovereign debt or corporate debt, or equities, which historically has actually been a good place to invest when there's been modest inflation.
Okay, so gentlemen, do you have recently did any clients with it? So how do you advise your clients in this very challenging time?
Well, we have, as you might imagine, constant dialogue with clients around these issues because there are economic challenges that, again, we haven't faced in a long period of time. So we have worked with our clients either individually on strategies that have levels of inflation sensitivity that perform well during periods of inflation, or where we manage assets where we have flexibility. We have shifted assets to areas that I referenced that give you protection for increasing rates.
Okay, so Dr. Wong, what do you think?
Well, we are also very interested in the development of inflation in the U.S. We don't have the first-hand experience of science of inflation in the U.S., but we are puzzled a bit by the pricing of the bond market in the U.S. because if you look at the inflation break-even rate, 2 year is like 2.5%, then it dropped to like around 2% over the next 24 months. So it seems to me the bond market investor don't believe that inflation or U.S. is enter a era for structurally higher inflation, which will last for long.
So Joe, what do you think?
I think that the markets and our expectation is that inflation, remember we've been reporting numbers on inflation that are in the 5%, 6%, 7% range. So these are numbers that, again, we haven't seen multiple decades. So the market's telling you, and we agree, is that inflation will come down, but it's not, in our view, going to come down to the 1.5% to 2% level that it was during a large portion of the cycle over the past decade or so. Mm-hmm. So you're going to have structurally higher inflation, whether that's in the 2 to 3% range or 3+. That's a bit of the debate about where inflation is going to be as you look out over the next 2 to 3 years.
Okay, Jill, I'm getting to my related question. So in a recent research note, you wrote that the Fed could end up playing checker while the economy is playing chess with potentially worldwide consequence. Could you elaborate a bit, especially to our audience who doesn't play checker or chess?
Well, I'm neither good at checkers nor chess, so But the point I was making is that there are certain inflationary drivers that higher rates are not going to resolve. So if you increase interest rates, it doesn't resolve the supply chain challenges we have globally. So the supply chain challenges are about port capacity, labor capacity, warehouse capacity, trucking capacity. And those issues don't get resolved with higher interest rates. Higher interest rates will serve to slow demand down, but not necessarily solve some of the other issues that are underlying drivers of the current pickup in inflation.
Okay, so how should the Federal Reserve play chess with the market? Should they raise their inflation target?
Well, I think the Fed is, as we speak, likely rethinking a bit of its rate path policy, given the uncertainty caused by the challenges in Eastern Europe. So prior to the oil price spike and the issues in Ukraine, our view was that they were going to increase rates 4 or 5 times over the course of the next year and a half. The market at the time had been expecting more of that. I think the Fed needs to be that much more careful now because you have other factors that are driving economic activity. A spike in oil will further tighten financial conditions and create economic problems.
Okay. So, Dr. Wong, the next question is for you. You just mentioned that inflation in the United States does not directly impact Asia market, but how would it impact Asia market indirectly?
Yes, it has had an indirect impact. For example, although if you look at data, China's inflation is very low, only 0.9%, and so this suggests that U.S. China are in completely different phase of the cycles. But the impact of high inflation in the U.S. has impact on China in the form of higher PPI inflation because of the strong economy and the higher elevated commodity prices. Drive up China's PPI inflation, and therefore you see this a sizable wedge between PPI inflation and CPI inflation, which create enormous cost pressure on Chinese meat and downstream industries. That's why, in fact, that segment tend to perform poorly last year. But if you look ahead, we expect the wedge between PPI and CPI inflation going to narrow, in part because commodity prices, global commodity prices, already start to soften, and the persistent high inflation in the U.S. mainly reflect in the non-tradable goods by our assessment. So looking ahead, I think U.S. higher inflation will have a less impact. A negative impact on China. Instead, as PPI inflation start to drop, and that will help ease the cost pressure on the meat and downstream industries. Again, we believe will eventually reflect in some kind of re-rating of the meat downstream industry, especially some manufacturing sectors stock prices.
Okay, so that's quite interesting because you mentioned that commodity price has already peaked, right? Mm-hmm. Even amid all these uncertainties. So, well,
of course, the higher oil prices, due to these latest geopolitical events, that create another uncertainty. But it's mainly reflecting the higher oil prices, right?
Okay.
So this impact will be somewhat different, reflect in a different form. Than the scenario we witnessed last year.
Okay, that's great. So, Joe, that is kind of related to my next question. We have quite a few renowned warriors currently. We have Jeremy Grantham from Boston's GMO, and he said the U.S. equity market is in a super bubble. And by super bubble, he means that is the fourth in a century. And he said that, I quote, the super bubble can wipe everybody out. Are you as worried as he is, or you are more on the optimistic side?
Certainly, I have great respect for Jeremy Grantham. He's a legendary investor, and we and many others listen to the things that he says about the markets. Our view is there has been a quite significant repricing of risk going back really into November and December of last year. So the expectation of 2022 coming into this year, in our view, was that you had a series of inflection points that were going to affect markets, create volatility, and make 22 a very challenging year. Those inflection points being a shift in monetary and fiscal policy, which would result in tightening of financial conditions, increasing rates, as we talked about. Liquidity was going to be affected by that, so less liquidity in markets. You had higher inflation. So these factors were going to create that level of volatility. So not necessarily beginning, but back in November, December, you saw a quite significant repricing of risk, in our view, related to the issues that I referenced. So in particular, in the higher speculative stocks that I think Jeremy Grantham and others, we included, were concerned about. So while the indices overall are down, in the case of the NASDAQ, which is a reasonable proxy for sort of aggressive growth, technology, et cetera, is down quite significantly. So while you're seeing it down almost 20%, underneath the surface, there's been a far more significant repricing of risk. The median and average stock in the NASDAQ is down more like 30, 40, 50%. So those are the names that I imagine Jeremy and others, us included, were concerned about because they were very, very aggressively priced on the expectation you were going to still see huge increases in underlying growth for those companies. So that repricing, I think, has taken some of that excess out of the market. And certainly on top of that, you've had, some of the other issues, of course, over the last, week and a half or so that have further reduced some of the excess valuations that Jeremy referenced.
Okay, so you don't believe there is, the U.S. market is in a super bubble, at least as extreme as Jeremy suggested?
I don't.
Okay, that's great. So, Dr. Wong, do you have anything to add? What do you think?
Well, I share Joe's view, and again, I also have enormous respect of Mr. Graham, but we don't have such a high conviction level as to make such a bold call. And it's true that in the past, when U.S. market experienced a major correction, it tend to take place during Fed rate hike cycle, like in the early 70s, the Nifty 50 bubble, and the late 90s, early 2000, the Nasdaq bubble, and the 2008 subprime crisis. But not all rate hike cycle lead to such a major collapse of the market, especially in view of the still generally low level of interest rates and still seem to us the normal level of equity market risk premium. But that said, I share Joe's view that I see the balance of risk to the current U.S. market outlook is to the downside, because after all, Federal Reserve is hiking rates when the growth momentum seem to be peaking, and this really in a very delicate situation. So and on top of that, you have this shock from Europe, and so I think at the current level, the U.S. market if were to sustain a rally, it would entail a significant turnaround in monetary policy stance in the U.S. That's my 2 cents.
Well, that's great. Happy to see agreement from two leading investment institutes, one from the United States and the other from China. I just hopefully, we can reach more agreement in other areas in the world too. So the next question is for you, Dr. Wong. Given that PBOC in China and major central banks in other developed markets are adopting different monetary policies, but RMB remains quite robust. So why is that?
Yeah, it's true. And the RMB exchange rate have demonstrated remarkable strength. But looking ahead, as you mentioned, that PBOC and the other central banks, represented by the U.S. Federal Reserve, are taking on divergent course of policy action. I think this warrant close watch, because the strength of RMB last year reflect at least two factors. One is that U.S. Federal Reserve was maintain a loose monetary policy. PBOC, Chinese central bank, have been tightening the monetary conditions, so such that you have this wide spread between China's rates and the U.S. rates that support their currency. Another reason being that last year China enjoyed strong external demand but weak domestic demand. This lead to a widening current account surplus. Again, it's an important policy factor for the currency. But this year, since U.S. China are in a different cycle, China is embarking on a easing cycle. U.S. is clearly on a tightening cycle, and so that will work in a reverse compared to last year. And at the same time, I think U.S. economy eventually growth will slow. That will have some dampening impact on China's exports. At the same time, Chinese demand will recover, will increase Chinese imports. So the favorable external conditions that supporting renminbi last year will also change. So we expect some softening in Chinese currency for the coming months.
Okay.
Yeah.
So Joe, what do you think? Do you see a depreciation or appreciation of RMB in the coming months?
I think Dr. Wong makes a very important point that the U.S. and China are on different phases of a cycle. So in the U.S., there is a very conscious effort to tighten financial conditions to deal with inflation that we discussed earlier. Whereas China, given the inflation numbers Dr. Wong cited earlier and that we've seen, is in a position to be more proactive, if you will, whether it be on the fiscal front or the monetary front, and has selectively provided stimulus to keep the economy growing at a reasonable rate. And that's a very different dynamic than we've seen over the course of the last number of years. And I think that has implications, as articulated by Dr. Wong, on currency and market conditions.
Okay, that's great. And another agreement, that's good. So, Dr. Wang, you seem quite bullish on Asia market for 2022. So, could you please explain to us why?
Well, we are bullish. Maybe we are biased because we are China-based, China-focused investor. But having said that, I think if we look at the big picture of this year compared to last year, the big picture is last year Chinese market delivered one of the worst performance among major markets, while U.S. One of the best. I think the key reason is that again the two markets experience different cycle. U.S. easing cycle, China tightening cycle, and in fact China tightened both monetary, fiscal, and the regulatory measures. And it's quite a difficult conditions for the market to perform. But in this year, I think the fortune between U.S. Chinese market will likely reverse. because U.S. is embarking a tightening, aggressive tightening cycle, and at the same time, China is increasingly become more supportive from authorities' measures. So we do expect a better performance of Chinese market vis-a-vis the rest of the world. But at the current juncture, it seems to us that the effect of U.S. tightening dominate the effect of PBOC easing. But looking ahead, after all, I think Chinese market will primarily be influenced by Chinese policy cycle and liquidity cycle. So over time, I think the easing effect of China's policy will eventually dominate the tightening effect of U.S. policy, and that should help Chinese Asia market to deliver better performance.
Okay, so where are we now in the cycle of economic recovery in China?
I think first there's already a major change, a major shift in policy stance, and the effect will likely show first in the credit cycle. I expect the turning point of credit cycle could be around end of first quarter, and with that of a turning point for credit cycle and the earnings cycle's turning point will likely if history is of any guidance. I think the earnings cycle could turn around by the beginning of third quarter. So that's why we tend to believe that Chinese Asia market is trading at a bottom range, and if you take a slightly long view, that's why we are bullish.
Okay, so exact the time to get into the market now.
Yes, but so far we have been wrong because the Chinese market along with the rest of markets of the world had experienced some rough times. But again, I think Asia market have outperformed other markets. But with the latest development in Europe. Of course, there's still tremendous uncertainty in the very near term, but if we look beyond the immediate near term, we still bullish on the outlook of Chinese Asia market.
So, Joe, what do you think of Asia market for this year?
Well, I think when we go through periods of significant macro volatility, and macro events, markets tend to correlate. So if you're risk off globally for equities, all markets are going to come under a level of pressure. So we've seen that recently. I think the range of outcomes is particularly wide and worrisome for us as we look at the events. They're unpredictable. There are significant sanctions in place that are going to disrupt trade patterns and energy markets. We're seeing energy, now above $110 a barrel, which has implications for economic growth. There is risk that further disruptions could drive a spike in prices even higher than they are today. That's not our base case, if you will, but there is a risk of that. So we're generally cautious on equity risk markets as we speak, given you've got shift in policy, you don't know what the Fed's going to do, you don't really know what the ECB is going to do, you've got uncertain geopolitical events in Eastern Europe, and the world is integrated. So on a relative basis, I would share the thought process that Dr. Wong articulated, that on a relative basis, given the slowdown that we expect in the U.S. that is going to probably be exacerbated based on some of the events of the past week and a half, and the policy issues that we're currently looking at, that the U.S. market's going to be going to have a challenging dynamic in 22. And I think, again, given that China is on a bit of a different cycle and policy is in a different place to provide a level of cushion against some of these challenges that I referenced, we're more optimistic, again, on a relative basis, but we would suggest caution on risk assets given the uncertain situations that we're literally seeing unfold daily.
But it is even more important to diversify at this time, right? So probably Asia can act as a diversifier.
Yeah, I think it's always important to diversify, given that we're always trying to deal with predicting the future, and that's really, really hard economically or individual company expectations, what have you. So diversifying, and I think given the size and depth of the China A-share market that we have been talking about for years as an important component of one's asset allocation. Neuberger Berman has a long history of investing in the A-share market, back to, I think we started investing in that market, 15 years ago. So, we're quite familiar with the market, and have been talking with our clients about having exposure there, given the size of the China economy that you want to have in the context of your broad asset allocation.
Okay, that's good. Joe, people in the United States are talking about the comeback of value stocks, and the trend started in probably become obvious in 2021, and it is even more apparent coming into 2022. Do you think the trend will sustain for the coming years?
I think the world, if you will, is probably underweight value. So I think that rotation has been an important one, a powerful one, and one reflecting a decade or more of underperformance by value and outperformance by growth. So investors that have broad passive exposure to U.S. equity markets are meaningfully overweight growth because the indices have become growthier over the course of the last decade. So that has required folks to rethink their diversification and allocate more to value. You also have, probably most importantly, in 21, a period of very accelerated economic growth. And value tends to do well during periods of accelerating economic growth. So in the boom phase of economies, you want to be exposed to value because value is composed of cyclicals and financials and, industrials, consumer discretionary, all things that are quite sensitive to accelerating economic activity or decelerating economic activity. So the point we're at today is quite I say treacherous, but one to be careful with because you're shifting from the boom phase to now a bit of a slowdown phase. So we're still certainly expecting positive economic growth in the U.S., but slower than 2021. So our view is that it probably starts to make sense to be sure you're diversified enough, even with your value exposure, because value will tend to have more headwinds during the slowdown phase, right? You certainly don't want to own value when you're slowing down significantly and moving into any recessionary phase, right? That's when you want to be hugely underweight value. Mm-hmm. And in the recovery and boom phase is when you want to own value. So the recovery and boom is where we've been 2020 and 2021. So it probably makes sense to begin shifting a bit back into, in our view, higher quality growth. And value's had a great run here over the course of the past 6 to 12 months.
So you don't think the coming back of value stock will be a decade-long reversal as some?
I think you want to, again, you made the important point of diversification. If you have equity exposure, whether it's China, U.S., global, wherever, you want to be diversified. Mm-hmm. And the Fed, for instance, may change course and not increase rates. You may see a resolution of the situation in Russia. We don't expect that quick resolution there, but those things may then foster an expectation of growth accelerating again, right? So you don't necessarily want to be all growth or all value, but we would lean a little bit more toward quality in particular, and lower beta right now because the risks are higher.
Okay, fair enough. Dr. Wang, do you think we are going to observe a similar trend in China?
We have some indication of similar trend in China, but I completely agree with Joe that I think the comeback of value investment, if you consider I would consider it's a cyclical instead of secular trend. A reverse of the last decade's relative performance between different style of investment. Because again, value names tend to be sensitive to the cyclical conditions. And if we were going to see a deceleration of growth, and at the same time, if U.S. Fed were to turn less hawkish and even turn dovish, I suspect that's when the growth will outperform cyclical and the value again. Okay. But for China, as we discussed earlier, China and U.S. are in a different cycle, different phase of the cycle. So I tend to believe that the rotation of styles, in fact, is a reflection of the macro business cycle and the liquidity cycle. Since the cycle are different, and the particular investment style between two markets will be also quite different.
So you think the major driver behind the rotation is not valuation, it's economic condition or liquidity condition?
Yeah, at the current juncture, I think the driver between underneath the short-term outperformance of value stock in Asia market probably more reflect underweight of much underweight of value stocks, and instead of the fundamental conditions, be it business cycle or liquidity cycle.
Okay, that's good. Dr. Wang, Chongyang recently published a report on Hong Kong market. Do you think Hong Kong market is a buy or sell now?
It has to be a buy because it's Hong Kong market valuation is so low now, and also Hong Kong market actually share the same economic fundamentals as the Chinese market, and in fact they are more sensitive to Chinese economic fundamentals. And with the turning around of policy cycle and expected bottom out of earnings cycle, we think both valuation and fundamental point to the same direction, that the Hong Kong market should do well in the coming quarters.
So do you think these giant tech names, the stock price of these stocks has already bottomed out?
Well, that's our view. In fact, we have started accumulate positions on those names.
Okay, it's a very positive view. We are good to hear that. Joe, what do you think? Do you share Dr. Wang's view on Hong Kong market?
Well, I think valuations, as discussed, have certainly come down, and on a relative basis, Hong Kong and particularly some of the big tech names are as cheap as they've been in a long, long time, and on a relative basis, cheaper than a lot of other high-quality, big-cap tech around the world. So there are, I think, lots of interesting selective opportunities there. One of the things that we're watching is you do have a pickup in virus cases, so it's something to watch. We've seen how, at least on a short-term basis, that can affect different markets and economic activity in various markets. So as the Omicron variant works its way through different parts of the globe, right, we've seen either more shutdown or more policy-driven issues that have caused short-term disruptions. But the underlying valuation is attractive. I think certainly, as discussed, the policy shift and changes that were put in place back in 2021 had a bit of a shock to the market, and I think that's now working its way through the system. And the valuations are as cheap as any market out there.
Okay, good to have another agreement. So Neuberger Berman is big on energy transition. Joe, I have a question for you. So how should you invest along the theme of energy transition in China in 2022, given that the government is trying to strike a balance between stable economic growth and the longer term goal of energy transition?
I think the energy transition that we're going through globally is going to be one of the most important trends that any investor needs to really understand and position themselves for. So if you and you have the challenging dynamic of a transition that is going to take many, many decades to achieve. So you want to be careful not to be think too much about 2030 and 40 and 50, because you could either lose or make money in 2021, 22, 23, 24, right? So there's a near-term issue where a number of the dynamics driving the energy transition are going to be inflationary. Mm-hmm. So it's something that is driving our view on structural inflation being higher. And depending on the pace of that energy transition, it'll either be more inflationary or a bit less inflationary. The transition itself is going to create tremendous investment opportunities. But investors do have to be disciplined on that, because as you've seen with solar stocks or other clean energy stocks, they can go boom bust in a relatively short period of time and get ahead of themselves, and you can lose money investing. But that transition is going to be important. We estimate that it will, to achieve net zero, whether it's by 2050 or 2060, is going to require multiple trillions of dollars of investment each year. So, probably $3 to $4 trillion of investment, which presents huge opportunity for investors, right? Whether it's energy infrastructure, clean energy, alternative energies, mitigation strategies. If you want to take carbon out of the air, if you will, right, that requires new technologies that create investment opportunities. So it's a very, very challenging dynamic. We're at Neuberger very client driven in this, right? There's some clients that absolutely want to be positioned for the energy transition and have focused on sustainable investing opportunities that help you take advantage of that, and they take a very long-term approach. Others who may have a more short-term tactical point, you can, if you positioned yourself to, own sustainable energy and be very underweight traditional energy, it would have been, it's been a tough environment. When you see, oil and gas increase the way it has over the course of the last, 4, 5, 6 months, you're going to underperform the market as a number of investors have. So it's a very delicate balance, and I think you don't want to be, unless you have a specific value-based decision to not own energy, carbon-driven energy. You want to be diversified, because you have periods that we're going through today that are where you've got carbon-based energy driving very significant returns.
It's a very tough question, and flexibility probably is key to answer the question. So the next question is So the next question is about ESG. Well, ESG is the buzzword in the investment world nowadays. I don't think I can get out of any interview without asking at least one question of ESG. So if you are investing in China through the lens of ESG, I was wondering, how do you strike a balance? Because on the one hand, you do not want to miss out these emerging companies with vast growth potential, and on the other hand, they are not necessarily ESG good case. So how do you decide, Joe?
Okay. So ESG is a critically important component of investing, as you described. probably every single client conversation that we have, ESG is an important topic that comes up. ESG, in our view, is about incorporating environmental, social, and governance factors into your investment process. It's not about excluding certain types of investment. There are clients that want to exclude certain sectors or types of investment, but broadly, ESG is about incorporating those factors into good bottom-up fundamental analysis. If you're investing in an energy company, you want to understand the impact of that energy transition that we just talked about. So, and assessing what impact that's going to have on the returns of the underlying company. We have a range of strategies that incorporate ESG. The vast majority of our strategies work those factors into the analysis. We have some strategies that clients have asked us to exclude certain categories, like energy or defense companies or other types of companies like that. But the core of ESG is making sure that you're aware of these factors and how they're going to affect returns in your investment portfolio.
That's quite interesting. As I recall, the Institutional Investor has recently published a great article on ESG, and in the article it is argued that not all ESG processes generate alpha. And the article argues that it is integration or engagement with companies, this process actually generates alpha, but simply excluding certain companies does not generate alpha. I think that is kind of consistent with what you've just articulated.
Yeah, when you restrict the investment options that you have, it often will affect your returns negatively. I mean, it's just sort of basic economics. But the issue that we think is important to think about in the context of ESG is materiality. This is about material issues in the context of environmental, social, and governance. So when you're analyzing a financial institution, you want to understand its lending policies, for instance, that might be considered a S factor, right? Do they have fair lending policies? Are they going to get in trouble with the regulators if they don't? Versus banks that have solar roofs on their bank branches, right? To us, that's not a material issue for a financial institution. The solar roof example I'm giving, versus the fair lending policies, which are a material factor. So as you go through each of the industries and the companies that you analyze, it's important to understand the materiality of these factors. It's not just about blanket ESG.
Okay, that's quite informative. Dr. Wong, what do you think?
I think Joe articulated ESG framework very well. I really don't have much to add.
Okay.
Thank you very much. I learned a lot.
Okay. I think that is a fourth agreement we've reached tonight. Okay, so in recent years, we have lots of new concepts in the investment world: blockchain, meta-universe, or space travel. Do you gentlemen think any of these concepts have the potential of change human society in a profound way? Joe, would you kick us off for this one?
We do. We think that there are a significant number of long-term, particularly technological transitions that are going to be quite transformational in our economy as you think about the next 10, 20, plus years. So these long-term secular trends and themes are an important area of investment for us. So we have developed over the course of the last number of years a thematic investing capability that invests in, digital transition, 5G, autonomous driving, fintech, carbon transition, infrastructure. All these areas have long-term investment implications that allow investors to get exposure to these secular growers. And if you're investing in a broad-based, large-cap universe of stocks, whether it's globally, U.S., China, or what have you, some of those companies are not necessarily going to be positioned for that long-term transformation that is occurring. So you do want to find small to mid-cap companies that provide that secular growth opportunities. So what we've recommended to clients is to both have exposure to broad-based equity, large cap companies, for instance, that are solid, well-run companies generating good cash flow and earnings, but have exposure to secular growers that that'll ultimately enhance the returns of your portfolio.
Okay, Dr. Wong, what do you think?
Well, those are very exciting concepts, and we are interested, and we start to put in research resources, but we haven't reached a level of conviction that allow us to really put money into work. And we think, as a investor in the secondary market, we tend to believe it's never too late to invest in great companies if they prove to be great. So we would rather be late than early in this regard, because we are value-based contrarian investor. We tend to be slow, and we also know that the psychology of fear of missing out tend to be a recipe for bad investment outcome.
Well, I was going to ask. Go ahead.
It's a really important point, because these thematic high growth companies are highly volatile. So Dr. Wong is appropriate to raise caution. To us, it's about a modest allocation and diversified portfolio, so you have exposure to those growth areas. And thematic investing has tended to be highly volatile. So they're important long-term trends, but you have to have the stomach, if you will, to withstand lots of volatility.
Wow, that's great. So Generation Z is entering the investment world in recent years. So how should asset managers globally prepare for Generation Z? Because their mindset tend to vary greatly from previous generations. Joe, would you start?
So I think it's a good follow-up to the previous discussion, because I think that is a group of relatively young investors that have been raised, for instance, with technology being an important part of almost everything they do, right? So whether it's using technology applications to invest, to build portfolios, to invest in passive or individual stocks or what have you. So it is a different mindset. That generational shift of wealth that is going to occur over the next multiple decades is an important one to understand, because what products and services were appropriate for a 60 or 70-year-old who has built up a lifetime of wealth is very different than someone who's 30 years old that may want to invest in a more socially conscious way, for instance, right? So ESG and sustainability are important trends. Using technology, many of them invest in passive vehicles or a do-it-yourself type approach. So direct indexing is an important trend for investors of that generation. So that's going to be an important shift that I think all of us in this business are going to have to get comfortable with.
Okay, that's good. Dr. Wong, what do you think?
Well, I consider Generation Z as a new generation representing new customer base or new consumer preference. But when it comes to investment, I doubt the Generation Z is a meaningful concept, because I suppose Generation Z are made easier to make investment. But easy to invest doesn't guarantee a good investment performance. In fact, maybe to the contrary, because investment, especially investment in securities, is a serious venture, require professional training, knowledge, deep research, and so on, and fast, easy access to investment opportunities may not guarantee good returns. I doubt Generation Z will have much of impact on the investment management industry. And in fact, I was wondering, what exactly Generation Z are doing? Are they doing investment or consumption? Because they enjoy the experience of participating investment, like the episode we witnessed last year. Is it in consumption behavior or investment behavior? I think this is interesting to watch.
Well, that's a philosophical question, I think. Well, and it proves that you are contrarian.
Yes.
Yes. So that's great. And so in any market, the top 10% companies contribute probably a great proportion of the overall market cap. Where should people look for the next Amazon, the next Google, or next Tesla? Joe, what do you think?
I think if you look back historically, the top 10 stocks or top 5 stocks in an index shift quite dramatically over longer periods. So if you look back 10 years ago, 20 years ago, 30 years ago, more, there's very actually little overlap in the stocks that are the current top 10 holders. I think in 2000, maybe Microsoft is the one stock that was in the largest market cap at that time and currently. So it's very hard to sustain the level of success over multiple years. So as good as the Apples and Amazons and Microsoft and Google, et cetera, are doing, and Alibaba and others are doing, you do have to watch it carefully, because as companies get to a very large size, the law of large numbers kicks in. It's just hard to continue to grow at a very rapid pace when you're that large. So the next emerging set of growth companies that are more in the small to mid cap range are the ones that you want to be on the lookout for. Some of those you may find through thematic investing we talked about, but that's, in our view, the importance of active management, because if you're only investing in the index, you're going to own those large companies, and if those large companies do poorly, so you've seen a lot of pressure on Facebook, for example, a lot of people, if they own the index, own a lot of Facebook, and Facebook has come under a tremendous amount of pressure and has underperformed the market, quite dramatically. So active management allows you to look for that next set of growth companies doing the bottom-up fundamental work that is necessary to find those opportunities.
That's a great point. Probably the top companies are only top when in retrospect, right? Because you cannot predict the next big thing, but it becomes apparent only in retrospect. So China in 2021, China set a dual carbon goal, and we kind of touched on it a bit. So I was wondering, how does the dual carbon goal guide your investment? Joe, would you start?
So I think the question gets back to the energy transition that we talked about a bit ago. So I think that the vast majority of policymakers and investors do believe that a carbon transition is necessary. We can debate what the impact of carbon is over the next 20, 30, 40, 50 years, but carbon in the air is not a good thing generally, right? So the question is, how do you position for that transition? Because energy companies are not the bad guys here. Energy companies produce the energy to keep this call on, to keep the lights on in this room, to keep hospitals well lit, to help people, grow food to feed the population. So energy companies serve a hugely important function in our society. And, what we have to do is work with them and engage in that transition to meet whatever carbon targets policymakers put in place, or the companies themselves, because many individual companies themselves have made a net zero, for instance, commitment of reducing carbon emissions over the course of the next 30 years. net zero commitment is that you're reducing your carbon emissions by 50% by 2030 and 100% by 2050. That's an enormously challenging goal. Enormously challenging. So you have to develop new technologies that are going to mitigate that carbon transition. Carbon, as much as we talk about electronic vehicles and automobiles or what have you, the electric grid, manufacturing processes, particularly things like cement and steel, and manufacturing and producing agriculture are about 70 to 75% of all carbon emissions. So that carbon transition has to address what you're doing in those three big buckets, right? We can make all the changes in the world for electronic vehicles and develop battery capability, but if we don't deal with the three big buckets, we're not going to reduce carbon emissions meaningfully over the next coming set of decades. So whether it's government goals, policymaker goals, company goals, I think the idea is you need to reduce carbon, you need to develop technologies that are able to do that.
Oh, that's quite helpful. Dr. Wong, what do you think?
Well, this carbon zero initiative could be the single most important theme for investment for many years to come. And China put forward a very ambitious, in my view, very ambitious goal, to achieve carbon peak by 2030 and carbon neutrality by 2060, which will involve humongous amount of investment in the area of optimization of energy structure and energy efficiency, reduce emission of fossil fuel, and build a modern energy system based on clean energy and electric and making the electrification of energy consumption. So huge amount of investment. Very challenging. At the same time, I tend to believe China probably in a strong, favorable position in coping with those challenges because unlike conventional energy, which is energy is produced based on endowment of natural resources, but in the new energy era. The new energy become a manufacturing activity, which in area where China enjoys some competitive advantage. And at the same time, like Joe said, I don't think we should write off the investment opportunities in traditional energy sectors, because there will be less investment, capital expenditure in those sectors. And there will be more supply discipline, so the existing players could enjoy quite favorable market condition and a competition landscape and pricing power. So, from an investment perspective, they could be a good candidates. And so I think we should devote much of research resources to this area, and there will be many good investment opportunities. Yeah.
That's a very informative call. Joe, the other day I was listening to a podcast that Patrick Liu, your China country head, has made a statement. He said that China's common prosperity concept is actually aligned with the ESG concept in the Western world. So I was wondering, what's your take over the concept of common prosperity?
Well, the common prosperity and the policies related to that are, in our view, very consistent with a lot of policies in Europe and the US. So when someone says income inequality in the US, right, by another name, that's an element of common prosperity. So the idea of spreading the wealth, if you will, developing sustainable economic growth opportunities that have broad-based impact on the population. So if you were able to listen last night to, the State of the Union, you probably weren't, but I did. The President Biden, State of the Union. Many of the things he talked about was about how do we ensure we're spreading the wealth in the U.S. economy. So how you implement that, the specific policies, how it affects economic growth. It's not necessarily inconsistent with maintaining good levels of economic growth. And it's going to take careful policy implementation. But it is something that, we were not necessarily surprised to hear, right? When you shift from a high growth, we've seen that in other emerging market developing economies, right? When you go from high growth to slowing your growth to sustain broad-based impact, you have to implement these policies that result in maybe a bit more regulation on business, maybe a bit more help on the lower end of the economic spectrum, and those things are important for every country, whether you're China, the U.S., Western Europe, or an emerging market in Latin America.
So, Dr. Wong, how do Chongyang interpret common prosperity?
Well, common prosperity is great. It's how can anyone doesn't like it? It's like a motherhood and apple pie. Right? So I think as Joe said, this is not just China's objective. It's shared by many countries in the world, and the key is about execution. How you're going to achieve common prosperity, and I think as long as it's carried out in a transparent, rule-based, and market-driven way, I think it will welcome. It will improve efficiency. It's like exactly as Joe said. It's consistent with the ESG framework. If the ESG we just talked about is at the industry and micro level, and common prosperity is like a macro level ESG. So it's great.
Well, the fifth agreement so far this tonight. Well, we all want a more just, more sustainable society. I think that is a shared value. So I've exhausted my question, and do you gentlemen have questions for each other? Jill, what do you want to ask Dr. Wong?
Well, as you look at the A-share market, Dr. Wong, what is your perspective on some of the sectors that you would want more exposure to as you look, is it financials or, consumer discretionary, healthcare? I mean, where as you think about, the best investment opportunities?
Thank you, Joe. I'm very delighted to have this opportunity to have this dialogue and discussion, and certainly benefit greatly from this discussion. Regarding your question, well, first, our judgment is based on top-down, a combination of top-down and bottom-up research. From top-down perspective, the reason we are bullish because the cycle, right, and both the earnings cycle and liquidity cycle work in favor of the overall performance of the market, potential performance of the market. When it comes to construction of the portfolio, we now focus on two types of opportunities. One type is the high quality large cap and names, including consumer and even large cap tech companies and healthcare. Those are the names which perform very well in 2020, but has since corrected, and now valuation come to a level which we think attractive. This is one type. The other type opportunity are those small mid-cap names which are not being not sufficient research attention have been directed at, because much of the attention of investors has been paid toward new energy, electronic vehicles, and those buzzwords, those very popular concepts, and such that there are many bottom-up opportunities, and which we think if we devote sufficient amount of time and research resources, we can discover individual alpha opportunities and to maximize our local knowledge. So we are having this barbell strategy. On the one hand, large cap names. On the other hand, pay attention to small mid caps and based on bottom up research.
Wow, that's lots of information. Yeah. Dr. Wong.
Thank you.
Well, do you have a question for Joe?
I do, but it's a question unrelated to what we have discussed so far today. In fact, one question I have is that what's the secret for Neuberger to have maintained such a high level of talent retention ratio?
I think it's, by the way, I also want to thank you both for our discussion today, and learned a lot from Dr. Wong. As it relates to Neuberger, one of the things that I think makes us unique is we're an employee-owned company. So we have broad-based ownership across all the investment teams within our firm, and broadly in the other areas of the firm as well. So the incentive structure is for stability and long-term success. And it also has an element of retention because folks are invested in the firm. It's a private company. So that has built, in our view, a culture of being good fiduciaries for our clients, a culture of stability, and a culture that has ultimately retained talent. As if you looked at our retention stats or our turnover stats, it's very, very low. People here have stayed at the firm for decades. And as I think we all know, that's important in the investment management world because you want to have, our clients expect stability. They want to know that if they're entrusting us with their very valuable assets, that the team that's investing those assets is going to be stable and be with the organization for a long period of time. So I think that's one of the keys to our success in attracting and retaining talent.
Thank you.
Well, that's a well-known secret sauce. Okay. So we are now getting to my favorite part of this conversation, which is quick questions. I will present a couple of questions, and you gentlemen only provide short answers. Shall we start now? Are we going to see bubble burst in big tech names in the United States in 2022?
I do not think that the bubble is going to burst. I don't think there's a bubble in large cap tech.
Okay, that's very informative. Dr. Wong, what do you think?
Correction, yes. Collapse, no.
Okay, that's also very informative. COVID, inflation, geopolitical tension, which is even more important for 2022?
I think inflation is the most important issue that the global economy is wrestling with broadly, right? Less so in China, but broadly inflation is the most significant.
Okay.
I think both inflation and COVID are important because they are the same. COVID is the root cause of inflation based on my supply side assessment.
Okay, that's awesome. So is 8 share a buy now? Joe, what do you think?
I think 8 shares are a buy, as we talked about a bit earlier, yes. And I follow Dr. Wong, so I'm going to follow his recommendation.
Do you want to make a disclaimer? Because he said he follows you.
Well, I follow Joe on this.
Okay, you follow Joe follows you. Okay. Oh, that's great. So the next question is for you, Joe. Competition in mutual fund in China is fierce. So despite that, why do you still want to expand your China business? There is no easy money anymore.
So we compete in a world that has fierce competitors all in every market we operate in, right? So that's not something that we've shied away from, whether it's in the US or Europe or other parts of the world. China, in our view, and again, we've been investing in that market for decades, is a very large, attractive market that's growing at a rapid pace. So while very competitive, we feel it's one that we want to give our clients more exposure to.
Okay, so the last question. What kind of return level should investors in the United States expect in 2022? 5%, 10%?
Well, I assume the question is focused on equities. I would say in equity markets, our expectation is you're going to have equity returns that are driven by two things. One, continued decent amount of earnings growth. So if you have earnings growth in the 6 to 8% level and maybe a dividend of 1.5% on top of that, combined with a contraction in PE multiples. So the combination of those two, in our view, results in an expectation that you're going to be more in the mid-single digit type returns, still positive, but not nearly the kind of returns that you've been able to achieve over the last couple of years.
Dr. Wong, what should Chinese investors expect?
Well, since you asked the question about the, the general level of the market, I'm reluctant to pin down a specific number because if you ask about the potential performance of our fund, I will be more confident.
That's not fair.
But having said that, I feel comfortable to say that I think Chinese market will outperform other markets. If you were to believe that Joe suggests that U.S. market could deliver, positive returns, if Chinese market were to outperform U.S. market, that's the answer. Right?
Okay, there is still some information, right?
Yeah.
Okay, that's what we have for today. Thanks, gentlemen. It's great. I enjoyed the conversation a lot. I learned a lot. I hope you too. Thank you very much. Stay safe.
Thank you.
Thank you.
It was great to be with you both.
Okay, bye bye.
Bye.
市场波动加大，调整预期，保持理性，可能才是2022年的投资决胜之道。对话全球顶尖机构，换一种思路看中国。感谢您持续关注中国基金报对话节目，再见。